Now let us start reading 26 of study session 8, which is understanding balance sheets. Under this LOS, we are going to look at the components of balance sheet and their usage in financial analysis. We also look at various formats of balance sheet presentation. Then we'll explain how assets and liabilities arise from the accrual processes. Then we'll compare current and non-current assets and liabilities. We will also look at the measurement basis of assets and liabilities. Then we will demonstrate classification and the accounting treatment for marketable and non-marketable financial instruments, which could be asset or liability. Then we'll list and explain various components of owner's equity. And finally, we'll understand the interpretation of balance sheet and statement of changes in the equity. So let us start with the various components of balance sheet. So this is a simple balance sheet. On the left hand side we have assets. On the right hand side we have liabilities and equity. Under these assets we have current assets and long-term assets. So the current assets could be cash, and there could be other current assets, for example the inventory or accounts receivable, etc. And their summation is this. This is current asset. Long-term assets or long-lived assets are investments or property, plant and equipments. There could be intangible long-term assets, for example patents, etc. And this is the summation of all long-term and current assets, that is total assets. If you look at the right hand side, there are current liabilities which are given to be 70. So these could be account payables, etc. Then there are long-term liabilities, the bonds which company had issued, and this is the summation of liabilities. This is total liability. Then we look at the equity, owner's equity. Firstly, there's initial paid in capital or contributed capital, which is 100, and the second part is retained earning. This is the part of those earnings which has not been paid as dividend but has kept with the company for further investment, etc. So if we sum these two up, we get 170, which is total equity, and the summation of total equity and liability is this 420, which has to be equal to the total assets. So that is how we balance the balance sheet. Let us move to the next slide. We look at the assets recognition. The assets represent probable future flow of economic benefit to the entity, and it is recognized when it can be measured with reliability. So these are the types of assets which are disclosed on the balance sheet. Cash and cash equivalents, which are current assets, inventories, trade receivables, prepaid assets, all of these are also current assets. Then there could be financial assets, there could be deferred taxes. These are the taxes which are already paid but they are still not due, so they are assets. Then we have property, plant and equipments, long-term assets. We can have investment property which is not part of our operations. There could be intangible assets, for example patents, brand value, etc. Then equity account investments, those are also assets. There could be natural resources, for example mines, etc. Or there could be assets which are held for sale, for example tradable securities, equities or bonds, etc. So these are various kinds of assets which we put on the balance sheet. Now let us look at the liability. The liability signifies probable sacrifice of future economic benefit to the entity as a result of past transaction or event. For example, if there was a bond issued by the company in past, then the company has to pay interest and it has to return the principal in the end. So we are sacrificing the future economic benefit to the entity. That is why it is a liability. Liability is recognized when the amount is received but not reported as revenue in the income statement. So this is the case of unearned revenue. So we have received the cash, but we have not really earned the revenue. We have not supplied the product or service. So that is a liability and has to be put on the balance sheet on the liability side. Similarly, there could be another case where amounts are reported as expenses, but they have not paid. So they are deferred expenses. So they have been consumed, but payment has not been made. So they are also liabilities. These are various types of liabilities which are put on the balance sheet. For example, bank borrowing, it could be long-term or short-term liability. Notes payable, again short-term liability. There could be provisions for bad debts, etc. There are unearned revenues, which are again short-term liability. There could be financial liabilities or accrued liabilities. And finally, there could be deferred tax liabilities. Tax which is due but has not been paid yet is a deferred tax liability. Now let us look at the another component, which is equity. So equity capital has these important characteristics. One, it is permanent. Second, no mandatory charges against earnings. And third is legal subordination to the creditors. So as we know, equity is subordinate to the creditor. So in case of any default, the first claim will be of bondholders, and then preferred shares, and finally the last claim will be of equity holders. And under this common equity accounts, we have the capital stock, that is initial paid in capital. Then there could be additional paid in capital in excess of par value. Then we can have non-controlling interest in subsidiaries or minority interest. We can have retained earnings from our profits, which is a part of common equity. And finally, we can have accumulated or other comprehensive income, so which is not the part of income statement but is put in balance sheet. So this was about the three important components of balance sheet. This balance sheet is used to make financial analysis regarding liquidity, solvency, and capacity to pay share owners. So if the company has current assets significantly higher than the current liabilities, that will say in short term liquidity is good. Solvency represents if the debt to equity ratio is lower, then it is more solvent. If it is higher, then it is less solvent. So all of these kind of information we can use from the balance sheet. So on these lines we have multiple liquidity ratios and solvency ratios which are useful for valuation purposes as well. Now let us move to the next slide. Balance sheet format. We can have various kinds of format of balance sheet. The first format is of report type, report format, in which we write assets, liabilities, then equities in a single column. So this is known as report format. The second format is of account format, in which we have already seen. So assets will be on the right hand side, on the left hand side, and equity plus liability will be on the right hand side. So this is account format. Third format is classified balance sheet. So it might be same as account format. The only difference is we are putting various items into subcategories, such as the current assets and non-current assets will be put separately. Similarly, current liabilities and non-current liabilities will be put separately. Financial assets and non-financial assets will be put separately. So we have subcategorization in a classified balance sheet. So that will give us more information within one category. And fourth type of format will be liquidity based presentation, in which we put all these say assets in a sequence of liquidity. Say for most liquid will be in the first row, and in the last we'll mention the least liquid. Similarly, we can say about the liabilities also. So generally in the case of banks, etc., we use liquidity based presentation in the balance sheet. Now let us move to the next slide. Here we will see the impact of accrual process on balance sheet, assets and liabilities. So if the revenue is reported but the cash is not received yet, in that case we call it as accrued revenue. So revenue has been earned, so it is reported in income statement, but cash is not received yet. So this revenue accrued is our asset. Similarly, we can have accounts receivable. If we have supplied the goods to the customer, but we have not yet received the cash, so this is account receivable, which is an asset. Let us look at the other case. Cash received before the revenue is reported. So cash is received, but the revenue has not been earned yet, so it will not go to income statement. So this is a liability. For example, deferred revenues. They are deferred revenues because we have already received the cash, but we have not provided the service or provided the goods. So the revenue is not earned yet. That is why it is a liability. So deferred revenue will become a part of liability. So all these differences are coming because we are following the accrual process. We are not following cash based accounting. That is why the difference is coming. Let us take another case where expense has been recorded but cash has not been paid. That is accrued expense. So the company has already consumed certain items but the cash has not been paid, so this is a liability. Similarly, accounts payable. Certain goods have been received from the suppliers but accounts have not been paid. The cash is not paid yet. That is also a liability. This amount will be paid in the future. It remains a liability. Now let us look at the last case where cash is paid before expense is reported. So this is prepaid expense. The company has already paid for the expenses which are going to incur in the future. So this becomes our asset. So prepaid expense is a current asset. So let us look into current assets and non-current assets in detail. So the current assets include the cash and other assets which are likely to be converted into cash or used up within 1 year or one operating cycle, whichever is greater. For example, the accounts receivables are expected to be received in the same operating cycle, or there could be inventory that is expected to be converted into cash quickly. For all these cases, we put them into current assets, which are either cash or can be easily convertible into cash within a year or within the operating cycle. So let us look into operating cycle. This is basically the time which is taken to produce or purchase inventory, sell the product and collect the cash. So that represents the full cycle. So it includes various aspects. First is the production, then the time spent in the inventory, then the time taken in selling the product, and finally the time taken in the collection of the cash. So if we add all these steps, we get the complete operating cycle. Now let us look at non-current assets. The assets which are held for continuing use within the business and which are not for resale. So those assets will form a part of non-current assets. The assets which are not consumed or disposed in the current period. For example, there is an asset which is to be consumed over multiple periods, that is going to be categorized as non-current assets. Non-current assets are also ones which represent the infrastructure from which the entire entity is operating. So it could be plant, machinery, etc. Non-current assets provide information on firms' investing activities. So non-current assets are typically long-term, which represent where the company is investing. So it might be investing in buying plants, buying natural resources, or certain machinery which is going to be employed for company's operations. Since these assets are going to be consumed over a longer period of time, they are categorized as non-current assets. Now let us look at current liabilities. So if they satisfy any of these criteria, they are categorized as current liabilities. The first one is they are expected to be settled in entity's normal operating cycle. We have already seen the definition of operating cycle. The second criteria is if a liability is due to be settled within 12 months from the balance sheet date, then we can categorize as current liability. And the third criteria is if the entity does not have the right to defer the settlement of this liability beyond 12 months, then it can be categorized as current liability. So except these cases, all other liabilities which are long-term are non-current liabilities. So non-current liabilities could be long-term bonds, etc. Now let us move to the next topic, which is measurement of assets and liabilities. So broadly, there could be two ways of measurement for the items in the balance sheet. One is historical cost, one is fair value. So historical cost is the value that was exchanged at the acquisition date when the company purchased the asset or issued a liability such as bond. That historical cost is verifiable and it is objective since it is already part of our accounts. So it is reliable, but again it may not be relevant. If it is very old, then it may not be relevant. So there is a challenge between reliability and relevance in investment analysis. Whereas if we look at the fair value, this is the amount at which asset can be bought or sold today, or a liability that can be incurred or settled between knowledgeable willing parties in arm's length transaction. So this is very close to the current market value, but it is subjective. Since the transaction is not happening in reality, the value is going to be subjective. So it is not going to be reliable, but the value is going to be relevant since it is very close to actual market value. So we need to make a balance between these two, reliability and relevance. That is why for some cases we use historical cost, for other cases we use fair value. So because of this mixture of measurement basis, the value of total assets should not be interpreted as the value of the firm. Because we know at some places we are using historical cost, other places we are using fair value. So the value of total assets may not be same as value of the firm. But still balance sheet can be used to better assess firm's investment potential or creditworthiness. It may not provide you the actual value of the firm, but still it is useful for the assessment of the potential of the firm or the creditworthiness of the firm. Now let us move to the next slide. It says the information in footnote. So even the information in footnote should be utilized in order to assess the firm better. And as we have already seen, since it is important, it is audited as well. So in footnotes, the basis for a particular type of measurement is given. Whether the company has used historical cost or fair value, the basis for that is given in the footnote. Similarly, the carrying value of inventory by category is generally shared in the footnotes. Categories could be finished or semi-finished, etc. So the carrying value is given based on these categories. Then the amount of inventory carried at fair value less cost of selling. Since the cost to sell is not the part of inventory cost, it is shown in the footnote. But that gives a fair idea how easy it is for the company to convert the inventory into cash. What are the further costs involved? Then the write downs and reversals, if there are any, and with the discussion or reasoning related to the circumstances, that is also shared in the footnotes. Finally, if there is an inventory which is pledged as collateral for liabilities If the company has made a short-term borrowing with inventories as collateral, then that is generally given in the footnotes. And using the information in footnote, we can even recognize inventories as an expense. So this is how the information given in the footnotes should be utilized for better valuation of the firm, better assessment of the firm. Let us move further. So we have different types of current assets. So first one is prepaid expense. We have already seen the expenses which have been paid in the advance but have not been consumed. So they are our current assets. They are going to be consumed in future. We have already paid for them. So that is first type of current asset. The second is inventory. So these could be finished, semi-finished or unfinished goods. So that is the current asset, since it could be converted into cash within the current operating cycle. And the valuation of this inventory is done on lower of cost or net realizable value. So if we know that realizable value of the inventory is going to be higher than the cost, then we simply use cost for the valuation of inventory. But if we know that the company has to sell it as a loss, since the net realizable value is going to be less than the cost, then we have to use the net realizable value for inventory. This cost includes all the costs which have been involved in bringing this inventory to the current location and the current conditions. But if we are valuing this inventory, we should exclude these costs. The first one is abnormal amount of wasted material. If it is more than the usual wastages, then it should be ignored. It should not be a part of the cost in the inventory. Storage cost beyond production process, that has to be excluded. Then admin overheads and selling and disposal cost. So these should not form the part of inventory cost. And when we calculate the net realizable value, we have the estimated selling price for the inventory. We subtract the estimated cost of completion if there is any incomplete product, unfinished product. And finally, we subtract the selling or disposal cost also. So this is the value which the company is going to be realizing for its inventory. If this value is less than the cost, then NRV should be used for inventory cost. If it is higher, then the cost has to be used. Now for the valuation of inventory, we have already seen there are three methods: first in first out, last in first out, and the average cost method. So we can pick any of them based on the requirement of the company and the accounting standards which have to be followed as per the regulation. There are other techniques for inventory valuation. One of them is standard costing, in which the normal levels of material, labor and production overheads are used. So this is actually based on the cost involved for material, for labor and other overheads. So this is based on the cost. And the second method is from the selling side. So it is based on retail sales price minus gross margin. So we have the standard gross margin, we just subtracted from the retail sales price, we get the value of inventory. So this is retail method. So this was about some of the current assets. Now let us look at the current liabilities. The trade or other payables. So if the amount of the goods and services promised has been already received, but cash has not been paid yet, so it becomes part of payables, which is a current liability. Similarly, notes payable. Notes are short-term borrowings which have to be repaid. So notes payable are current liabilities. Then current portion of non-current borrowing. So there could be some long-term borrowings for which some partial payment is due, which is current portion of the borrowing. So that is current liability. Current tax payable. The tax which is already due but has not been paid yet is current tax payable, current liability. Similarly, accrued liability and the unearned revenue. Revenue which has not been earned yet but the company has been already paid for that. So that is another current liability. Let us move to the next slide. Accounting for long-term assets. So we have seen so far the current assets and liabilities. Let us look at the long-term assets which convey benefit to the firm over a longer period of time. So there could be of broadly three types: tangible assets like land, building, equipment, etc. There could be intangible assets such as copyright, patent, trademarks or other kind of intellectual properties, franchisee, goodwill, etc. There could be natural resources such as oil fields, mines, timberland, etc. So property, plant and equipments, they are recorded at purchase cost, which is a historical cost. It includes shipping and installation, construction cost, including labor, materials, etc. and also the interest cost, which was paid while the plant was being constructed. So that period interest becomes the part of the purchase cost or historical cost. So that is going to be used in the balance sheet. For tangible assets which are not used in the operation of the firm, they should be classified as investment assets. Suppose there is some kind of tangible asset or equipment which is not the part of operations, so that should be classified as investment asset. Now let us move to the next slide. Depreciation or depletion. So if we have tangible assets, we know that they are going to be consumed for a longer period of time, so their value will increase with time. So they are to be depreciated in our balance sheet. So depreciation is the allocation of the cost of these tangible assets over long period of time. So if we have a machine which has been bought a certain price, we know that price has to be allocated over the period of the useful life of the machine. So that will be depreciated over the period of useful life. But land, which is a tangible asset, is never depreciated. It has to be taken as it is. Then let us look at the natural resources. As we know that natural resources such as mines or oil fields, etc., they are used up over time. So they get depleted with usage. So depletion is the allocation of cost of natural resources and they are used as cost per unit. So as the natural resources are used by the firm, the depletion rises. So that is why it is not based on time, it is based on the cost of natural resource used per unit. So that is how we have these balance sheet values or book values of the assets as historical cost minus accumulated depreciation or depletion till that point, unless the asset values are impaired. There are certain cases where the values could impair, so that has to be a part of it. Otherwise, simply historical cost minus accumulated depreciation becomes the book value of our asset. Now let us look at the intangible assets. So there could be of two types, identifiable or unidentifiable. The intangible assets which can be acquired singularly, which can be linked to rights and privileges, and which have the finite benefit periods are categorized as identifiable intangibles. So that is why they can be amortized over the estimated useful life. Since they have finite benefit period, so we can amortize them. For example, patents, copyrights, etc. These are identifiable intangibles. There could be another types of intangibles which cannot be acquired singularly and they do not have a finite benefit period. So they have infinite benefit period, for example goodwill. So they cannot be amortized since they do not have a fixed benefit period, but they should be reviewed annually if there is an impairment in the value. They may be recognized only if they can be measured reliably. So that is important. For example, goodwill can be recognized only in the case of acquisition. Otherwise, the goodwill of the firm cannot be known. So it cannot be recognized. The unidentifiable intangible also excludes internally generated intangibles because there will be a lot of subjectivity. For example, if there is internally generated brand value or goodwill, it cannot be recognized. But if it is acquired or purchased, in that case, it can be recognized, since in that case there is no subjectivity involved. So typical example of intangibles are patents and copyrights which have been purchased, purchased brands and trademarks, purchased franchise and license cost, direct response advertising, goodwill, and computer software development cost. So these are typical intangible assets. Let us look at goodwill. Goodwill is the difference between the acquisition price and fair market value of all the assets of the firm. As we know that in the case of acquisition, the company which is acquiring pays much more than the value of the assets of the firm, and the difference is because of the goodwill or the value associated with the company's name. So it can be simply calculated as acquisition price minus fair market value of net assets which are being acquired. So we know that if there was no acquisition, we can never know the value of goodwill in the balance sheet. So it can be recognized only in the case of acquisition. So the additional amount which has been paid represent the amount paid for the asset which is not recorded on the balance sheet, which is categorized as goodwill. So as we have seen, it involves management discretion. Since the management is paying much more than the net fair value of the assets, so that depends on the synergy or increased future cash flows which are expected by the management. And that is why we cannot amortize goodwill. Though it can be checked for the impairment, it cannot be amortized. So the impairment in goodwill indicates that it often results from overpayment of the entire equity. So the impairment of the goodwill indicates that it often results from overpayment in the case of acquisition of the entity. We should remove the impact of goodwill when we are calculating the ratios. So it should be removed from the assets. And if there is an impairment which is being used in the income statement, even that has to be removed. So once the impact is removed, only then we will be able to fairly calculate the ratios and compare them across the industry. Now for the evaluation of business acquisitions, these are the things which are considered. First is the purchase price, the net assets which are being offered, and the earning prospects. So if their earning prospects are very promising, the company may be willing to pay more than the value of net assets because of the goodwill. Let us move to the next slide. Financial assets, liabilities. So the stocks could be financial asset or liability if the company has issued stocks in the starting to raise funds through equity, that will be a financial liability. If the company has made certain investments in some other company through buying equity of that firm, that could be financial asset. Similarly, bonds could be financial asset or financial liability based on whether company has issued bond to raise funds. That case it is financial liability. And if company has bought the bonds of some other company, then it is a financial asset. If we look at the receivables, they are current assets. Notes receivable, again they are type of current assets. Notes payable will be current liabilities since they have to be paid. Loans are liabilities. Similarly, derivatives could be asset or financial liability based on the way we have created them. Now again, the financial assets or liabilities might have two prices. One is a historical price and the second is the fair value, current market value. So some of these are reported as at their fair value, while others are reported at the cost or present value. So now let us explore in which cases they are to be treated at fair value, in which cases they have to be put in the balance sheet at the cost or present value. To calculate fair value, they are marked to the market or they are reported at a fair value. We just find out what is the current price in the market and calculate the unrealized loss or profit. Now let us look at them in detail. So firstly, we'll look at the financial assets or liabilities which are measured at fair value. So let us look at the assets first. Trading securities, the securities in which we have made investments just for the sake of trading and company does not have any long-term interest in them. So they are to be measured at fair value or current market price, since they can be sold at any point in time. Similarly, the available for sale securities. These are the securities which are kept for a slightly longer term, but they are available for sale. They can be sold at any point in time. So again, they have to be put at fair value. Then the derivatives, they could be standalone derivatives or they could be embedded in another non-derivative instrument. So in that case, they also have to be put at fair value or the market value of the derivatives. And on the same lines, the assets with fair value exposures, but which are hedged by the derivatives, even in those cases, the assets will be put at fair value, since their exposure has been hedged by the derivatives. Now similarly, the financial liabilities, if the derivatives are on the liability side, again they have to be put at fair value. And the non-derivative investments, where their fair value exposure is already hedged by the derivatives, in those cases also we will put the financial liability at fair value. Now let us look at the another kind of measurement, which is at cost or amortized cost. If the financial assets belong to these categories, their value will be measured at cost or amortized cost. For example, if there is over-the-counter instrument or unlisted instrument, we cannot find out what is the actual fair value or the market value for that particular instrument. There we have to put it at cost or amortized cost. Similarly, for held to maturity investments, so these are the investments where the company's intention is to hold it till the maturity of the investment. In that case also, we should not be influenced by the current market value of the security. We will put it at cost or amortized cost in the balance sheet. Similarly, loans which are usually long term, they should also be put at amortized cost. And similarly, the receivables also we keep at amortized cost. On the same lines, the financial liabilities such as bond, notes payable, etc., they also have to be put at the amortized cost. Now based on this treatment of measurement, we can classify these securities as the following. There are three types of securities: held to maturity, trading securities, and available for sale securities. So this is the classification based on the treatment in the balance sheet and income statement. So let us look at the held to maturity security first. So these are the debt securities which company intends to hold till maturity. For example, the long-term bonds of some firm, etc. Here the securities are carried at the cost in the balance sheet. So we are not looking at the fair value of those instruments. We are just looking at the cost when we are putting them in balance sheet. And in the income statement, all the realized gains or losses will be entered only at the disposal. So unrealized gains will not be put in the income statement in this case. Now let us look at the trading securities. These are the securities which are acquired for the purpose of selling in short term or near term. There is no long term intention to hold them. So they are carried on the balance sheet as the current assets at market value. Here we are not looking at the historical cost or amortized cost. We will just put them at market value, since the intention is to sell them in the near term. And in the income statement, all the dividends, realized and even unrealized gains or losses are to be put in the income statement. Unlike held to maturity securities where we are not putting any unrealized gains or loss in the income statement, for the trading security we are doing so. Now let us look at another type of securities which are available for sale. So these are somewhere in between the two. So they may be sold to satisfy the company needs. So they are available for sale. If the company feels the need of selling, they can sell them. They could be debt or equity. The available for sale security could be current or they could be non-current. And since they are available for sale, they are put at the market value. Just like trading securities in the balance sheet, they are put in market value just as a trading security. But in the income statement, the treatment is same as held to maturity security, as we are going to put only realized gains or losses at disposal in the income statement. The unrealized gain or loss will not form the part of income statement in this case, same as held to maturity security. Now in order to clarify this issue further, let us take a numerical example. The company purchased 1000 shares on 1st of January for $30 per share. At the end of the year, the market price became $50. Dividend of $1 per share was paid in that year. Now the question is asking the balance sheet and income statement entries for that year. If these shares are classified by the firm as held to maturity, available for sale, or trading security. So we need to find out the treatment in all three cases for balance sheet and income statement. So let us find out. As the company is still holding these shares, so there is no realized gain or loss, that is 0. Let us look at the treatment of dividends received. Dividend was $1 per share for 1000 shares. So $1000 was reported as income. Since it is realized, so this is realized gain, so that will go to income statement. So here when we said realized gain or loss, it was capital gain or capital loss. Since we have not sold the security, the capital gain or loss is going to be 0. But there will be an income due to dividend. So that has to be a part of income statement. So this realized gain of $1000, this has to be part of income statement regardless of the classification by the firm. As we know, the realized gain is going to be the part of income statement in all three categories. Now let us look at unrealized gain. The company has purchased the share at $30. The current market price is $50. So the unrealized gain is $20 per share. There were 1000 shares, so 20,000 is the unrealized gain. That is, if the company plans to sell these securities in the market, the company is going to receive $20,000. That is unrealized gain. Now we know the treatment of unrealized gain is different in different kind of securities. So let us assume the first case where we are taking them as trading securities. So company does not have any long-term interest in these securities. They are just for the trading. So we are going to enter the unrealized gain in the income statement. So 20,000 gain is shown in the income statement. So net income rises by that amount. And even in the balance sheet, they are going to be put at market value. So they are going to be put at $50. And because of that, the value of asset rises and retained earning will rise. So to make a balance, it will come from the net income. Now let us look at the case where we are assuming that these securities are available for sale. In that case, we know the treatment for income statement is going to be the same. We are going to put unrealized gain in the income statement. For available for sale securities, we know that the income statement is going to be the same. The unrealized profit will not be the part of income statement, but the balance sheet should use market value, not the historical cost, but the market value, which was $50 per share. So the extra 20,000 should form the part of comprehensive income in the balance sheet. So this income of 20,000 is not the part of income statement, but it is a part of balance sheet in the form of comprehensive income. And because of that, we can show the market value of those securities to be $50. So we purchased them at $30. $20 was the gain per share as comprehensive income, and market value is $50. Now let us look at the third case where we are keeping them at held to maturity. So as we know, in these cases as well, the unrealized gains are not reported to income statement, just as earlier. It is not even included in the comprehensive income at the balance sheet. So since we are planning to hold them till maturity, in the balance sheet will not show the current market price, it will show debt as amortized cost, but in this case we are talking about equity. So any unrealized gain will not affect asset or equity. So they are just going to keep them at cost itself. So now let us summarize this. The dividends and realized gains, they always appear on the income statement. As we have seen, irrespective of the treatment of the security, they are going to form the part of income statement. If there is any unrealized gain or loss, it will affect the income statement only in the case of trading securities. As we have just seen, for the case of available for sale or held to maturity security, it did not affect the income statement. Now we will see the impact on balance sheet. The unrealized gain or loss on both trading and available for sale securities reflected on the balance sheet. And unrealized gain loss for available for sale securities comes as comprehensive income in the balance sheet, but it does not form a part of income statement, which we have just seen. So now let us move to the next topic, just components of equity. In the equity in balance sheet, we put capital, which is contributed by owners or paid in capital. Then we also put the minority interest, which could be non-controlling stake in a subsidiary. Then we have retained earnings, which is the part of the profit which is not paid as the dividend and kept with the company for further investments. Then there could be treasury stocks, which is going to be used for stock options, etc. They also have a dilutive impact on the equity. And if there is any comprehensive income, that also part with the equity itself. Now let us look at this comprehensive income further. This comprehensive income aggregates net income and certain special transactions which are not reported in the income statement, but it is affecting stockholders' equity. As we have seen in the case of available for sale securities, the unrealized gain was not the part of income statement, but it was affecting the balance sheet. So it should form a part of comprehensive income in balance sheet. Here these special transactions comprise other comprehensive income. So when we talk about comprehensive income, it is a summation of net income, which is coming from the income statement, and other comprehensive income, which was not the part of income statement. So this is an income measure over a period of time, which includes net income and other comprehensive income for that particular period. So when we say accumulated other comprehensive income, it does not include net income, but it is a component of shareholders' equity at that particular point in time. Now let us move to the next topic, which is statement of changes in the shareholders' equity. The statement of changes give the information about changes to the company's net assets or company's wealth. So with respect to the comprehensive income, the following items should be disclosed so that we can understand if there is any change in the stockholders' equity. So these are the unrealized gains or losses on available for sale investments, which we have just seen. Then gains or losses from any derivatives that qualify as net investment hedge or cash flow hedge. So if we are using this derivative for hedging a cash flow or investment, then gains or losses from that should be a part of the comprehensive income, which should be disclosed. Then if there is any minimum pension liability adjustment for defined benefit plans, then that should also form part of this comprehensive income. And finally, if there is any foreign currency translation adjustment for a foreign subsidiary company, then that is also a part of this. So any changes in them will affect the stockholders' equity. So they should form the part of the statement of changes in shareholders' equity or stockholders' equity. Now let us move to the next slide. Uses and analysis of balance sheet. So once we have the balance sheet with various details of assets, liabilities and equity, how do we use it? So first purpose of the usage could be comparison. For that we prepare common size analysis, that all the balance sheet items are calculated as a percentage of total assets. Since we have all items as a percentage of total assets, we can compare it with the other balance sheet of different companies in the same sector or in different sectors. And we can also compare the balance sheet of the same company which was a few years earlier. So in other words, we can call it can be a horizontal comparison with other companies, or it could be a vertical analysis or time series analysis. So we can have time series analysis or cross-sectional analysis. Cross-sectional analysis is with other companies, and time series analysis within same company at different time intervals. So the percentage provides us the comparative perspective here. So now everything is stated as a percentage of total assets. Another way of looking at balance sheet is based on balance sheet ratios. So there could be various types of ratios which are calculated from the balance sheet. One could be liquidity, another could be solvency ratios. They give an idea about the financial flexibility, the macroeconomic relationship, etc. regarding a particular company. So let us take an example of a few liquidity ratios. So they give an idea about the liquidity in the company. For example, the current ratio, which is the ratio of current assets and current liabilities. So the value of current ratio is good. That says the current liabilities will be paid within time. The company has good liquidity. The other type of liquidity ratio could be quick ratio or asset test ratio, which is the current assets minus inventories. Here we are assuming that inventories may not be able to convert it into cash very easily. So current assets except the inventory divided by current liabilities. So that gives us an even better picture of the liquidity. And finally, the most conservative ratio regarding liquidity is cash ratio, where we have just cash divided by current liabilities. So it says if we have sufficient cash to pay for the current liabilities, all of them present the condition of liquidity in the firm. That is why they are known as liquidity ratios. The solvency ratios represent whether the company is going to be solvent. So they could be debt equity ratio, which is debt divided by equity, or there could be long-term debt equity ratio, where we have long-term debt divided by long-term equity, or we have debt ratio, which is total debt divided by total asset. So higher is the debt taken by the company, poor is the solvency of the company. So we are getting all this information for these ratios from the balance sheet. That is why they are known as balance sheet ratios. So now that has brought us to the end of this topic. Let us look at a few questions. The assets are equal to liabilities plus equity in the balance sheet. This is by definition itself. So B is the right answer. Question number 2 says which of the following is a current asset? We know that machinery is a long-term asset. Even goodwill is an intangible long-term asset. Inventory is the current asset. So C is the right option. Now let us look at the headings under which these various elements come. So we know the accounts payables are liabilities, which are short-term liabilities or current liabilities. Inventory is current asset. We know land is a long-term asset and it cannot be depreciated. Bonds, if the company has borrowed or issued bonds, it will be long-term liability. Similarly, stocks, they will be part of equity, long-term. Prepaid expenses. So the expenses for which we have already paid but we have not consumed. So this is short-term or current asset. The outstanding wages which are to be paid, so that is why they become liability in short term. So current liability. Creditors which are to be paid in short term are again current liability. The debtors from which we are expecting a payment, so that becomes current asset. Cash is also a type of current asset. The preference shares form the part of equity. The patents are intangible long-term assets. So in a classified balance sheet, the short-term and long-term assets and liabilities have to be put separately. Goodwill is going to be long-term intangible asset. Tax payable is a short-term liability or current liability. Retained earnings form the part of equity. So that gives us a good idea about various elements in the balance sheet